Hi there. Welcome to Commodities. I'm Lindsay Biscaya, filling in for Andrew Bell today. Let's take a look at how some key commodities are trading. Here are the energy prices to start things off. We're looking at oil, gasoline, and natural gas. Oil prices trading down today, with analysts pointing to increased supply expectations. Gasoline prices also sliding modestly, albeit, but reflecting what we're seeing with the price of oil. If we look at natural gas, though, it's trading up by more than 5% at the moment. And if we take a look at the price of metals this afternoon and how some of those are trading, we'll, of course, be digging into these throughout this show today. Gold, silver, and copper. You can see once we get this chart up here, copper is down. We're going to be talking about that quite a bit. It's fallen from its record highs after a bit of a sell-off by investors. The price of silver plunging today as well, down by more than 3%. This comes as traders assess market tightness and potential U.S. tariffs. And then the price of gold also dropping, not as much as silver and copper, but still down today after some significant runs that we saw from all three of these metals heading into the new year. And here's some stories we're watching for today. The U.S. has seized two more sanctioned oil tankers days after capturing Venezuelan President Nicolas Maduro. The U.S. says the vessels were tracked and found to be conducting illicit activities. One of the ships was sanctioned last year and had been involved in the Russian oil trade. The Trump administration has now seized 4 tankers since imposing a quarantine on ships going to and from Venezuela. British Columbia Premier David Eby says Canada should prioritize building more oil refinery capacity over new pipelines. That response comes after Alberta Premier Danielle Smith called to expedite new pipeline infrastructure to the BC coast. Eby says the existing Trans Mountain pipeline is not at full capacity and could be expanded further. These remarks come amid the threat that Venezuelan oil could begin to displace Canadian crude in U.S. refineries. And shares of Newmont are trading lower today after the gold producer cut its first quarter output expectations. That move is due to infrastructure damage at a key mine in Western Australia, which has been caused by wildfires. Newmont cut its gold production forecast by 60,000 ounces and says its processing facility will run at a reduced rate of 60% until the infrastructure is restored. The company will take a hit of $220 million US as a result. U.S. President Donald Trump has announced Venezuela will be supplying 30 to 50 million barrels of oil to the states. However, Deloitte Canada's latest energy, oil, and gas price forecast report highlights an already saturated oil industry. Here to talk more about that is Andrew Bottrill, Energy Resources and Industrials Partner at Deloitte Canada. It's good to have you join us this afternoon. Thanks so much.
Good afternoon.
So we're seeing potential oil production ramping up coming out of Venezuela, but this comes at the time when we're probably going to see an oversupply of oil globally. How does that all factor into each other?
Yeah, not probably. So we are seeing an oversupply in oil and have for the better part of the last 9 months. So what we have right now is about a 3 million barrel oversupply. And it's something that we need to work through. So we're expecting relatively tepid, kind of $58 is what our forecast is for WTI this year. And we're cautious that the first half of the year might be a little careful as the market kind of goes through this oversupply. And of course, the news that you just talked about with additional volumes cutting out of Venezuela certainly puts some downward pressure on what the near-term price might look like in the next 3 to 6 months. But I think we do think that we're going to work through this oversupply in the next year, and we'll exit 2026 in a better spot.
Let's go through your report, like some of the key findings from your report. What were they?
Well, ultimately, I think, we really talked about the oversupply of oil and how we need to work through that oversupply here in the next quarter or two. But the other part of the report that I think is the positive news is just how much of a better structural natural gas environment we're going to have in Canada, in the U.S. this year. So with LNG Canada going off the West Coast here and more cargoes going out from LNG Canada in the first and second quarter of this year, we're seeing a much more sound natural gas environment, which means we're going to see far better prices on the natural gas side. So that's a good news story for the Canadian producers out there.
I want to talk a little bit more about the oversupply that's impacting investment decisions globally. Like you talked about the fact that we're already seeing oversupply in the market. I mean, how is that impacting decisions that are being made really around the world?
Absolutely. So I think Canadian producers, U.S. producers as well, they're all being challenged with how do we continue to demonstrate strong economics in our organizations? How do we look at maintaining budgets, maintaining activity, maintaining flat to maybe slight growth, but doing so efficiently, right? So I think what companies are being really careful on is as they look to their budget, I think we'll see them being careful in the first half of the year on their activity and capital spent and staying away from debt and making sure that they're really ready for price volatility should it come through this year and make sure that they're not growing and spending too much capital too fast.
Do you see a world in 2026 where domestically or internationally there's kind of like increased demand to meet that oversupply?
We do. And there is a relatively strong demand picture out there as well. So I think that's what's going to help get through a lot of this oversupply that we have right now. But as we look across, if you look in Canada, US economies, we have lower interest rates, more activity. We're expecting it to be a more robust economic season coming up here in the next year or two. And with that, I think that's going to help be the part of the engine that's going to chew through some of that oversupply.
You mentioned LNG exports, and specifically when we're talking about Canada, like where does Canada stand in terms of these exports? Can we expect the country to have like increased demand capacity in the next couple of months or throughout the year?
Well, I think we're early to the game with new projects, some being constructed, some on stream right now. So I think this is an industry that's just kind of at its early stages and it's starting investments. But I think there's a lot of excitement about we're now being in operations and we're actually sending gas off the west coast of Canada. And I think a lot of organizations are looking at that as like, this might be the proof that we have now for what an LNG investment looks like. And as we continue to build on the projects that are in construction right now and maybe get a few more over the line, we could see a really robust 5 or 10 years of natural gas demand for LNG. And it's an opportunity for Canada to maybe grow and catch a second wave of LNG that we, in all honesty, missed kind of last time.
Okay, you talk about, sending natural gas off the West Coast, but of course there's plans to send more oil, maybe, off the West Coast, depending on what happens with the federal government and Alberta and a lot of different legislation surrounding the latest pipeline that Alberta wants to build. If there is a new pipeline in Canada, is that a good idea for Canada right now, given this kind of oversupply issue we're seeing?
Well, I like to make sure that we talk as well about the expansions that you talked about in your last news story as well, right? We have expansions that have been done to the West Coast already. Potential new one coming that's looking to get invested. So there's expansions into the U.S. But I also look at the long-term prospects, and that's what's important. It's the long-term prospect of a large pipeline to the West Coast. That's about 5-10 years down the road, large project to look and build like double-digit growth for Canadian producers, right? So it's one of those options that I think we need to be ready to look at, and I think there's a lot of complexity to each of those. We got to look at the global supply and demand, and Venezuela now is going to be delivering more heavy oil than they have in the past decade. So we may see them play a role in the next decade. But there's a lot of work that needs to be done to prove these projects economic. But I know that industry is excited to actually see that there is maybe an appetite to do that and to deploy capital and potentially grow out in that time frame.
It's so hard to look 5-10 years down the road geopolitically as well, especially as you say, given what just happened with Venezuela over the weekend and how that might change things 5-10 years down the road in terms of oil production.
Absolutely.
That's all the time we have, though. Appreciate you joining us today. Thanks so much.
Thank you so much.
That was Andrew Botterill, Energy Resources and Industrials Partner at Deloitte Canada. Well, industrial metals have seen record highs recently. We'll discuss more on what 2026 holds for the sector. That's coming up right after the break. Metals, including copper and nickel, dipped today after seeing record highs this week. Another rally comes as demand is surging amid fears of U.S. levies on metals. And here to talk more about this is Kenneth Hoffman, head of commodity strategy for Red Cloud Securities. It's good to have you join us. Thanks so much.
Thank you very much for having me.
I just want to get your take, first of all, on what we're seeing today in terms of the prices of nickel, copper, even gold and silver. Like, what's some of the reasons for the dip we're seeing today, do you think?
Well, volatility has been at an all-time high. It makes day traders very happy to see markets like this. But I think the overall trend that you're seeing in markets have been very strange. I've been looking at commodities for 35 years. I never saw anything like this where it's geopolitics and trade and actions by the US government and the Chinese government that are really whipsawing commodities, which, again, it's very, very strange to see this type of movement and pricing not based on traditional supply and demand.
It's so interesting. Why do you think now we're seeing this? Like, what's changed geopolitically compared to years past that's actually causing, prices to go up and down based on what's happening politically?
Well, early last year, President Trump announced that he would go after copper imports, and a lot of people felt as if, well, that's going to cause some sort of problem with getting copper in the United States. And so the COMEX, which is the Chicago Board of Trade, you've seen copper inventories rise. A year ago, they were about 92,000 metric tons. Today, they're almost 510,000 metric tons. So again, globally, you've seen copper inventories rise to almost 800,000 metric tons. So demand has really come from the building of inventories, not really normally what we see, which is good demand. And that's my problem with the copper market right now is demand has been soft and it seems like it's getting more soft. And I think traders are trying to go between the economy doesn't look so hot in China, it doesn't look so hot in North America. You saw Canada, some people take down their economic numbers. In the US, there's a 30% chance of recession. I think that number might go up during the year. And so you're looking at that, but juxtaposed to that, you have the US government doing all sorts of national intrigues and trade attacks, et cetera, and that's what's causing all the volatility in the price. People don't know what to really do next.
So, okay, apart from seeing the dip today, given everything you just mentioned, do you foresee, copper, nickel continuing to go on a bit of a run in 2026, like what we saw in 2025 and the first couple of days of 2026?
I'd be a bit concerned. I know pretty much every analyst out there is bullish on copper, but in my years of training, I like to see supply and demand dynamics. And again, the demand last year came from inventory build. It didn't come from real demand. And so in essence, all of that copper that was produced last year is just sitting in a warehouse someplace, either in London or in Chicago or elsewhere. And that material at any point could come back into the market. We also saw a year where we saw an extraordinarily high amount of high profile outages at mines, and those tend to go in cycles. And so if I'm looking at the copper market, I would be concerned about one, if the economy in the US and China continue to slow, that's a problem. Two, if these inventory builds start to subside or worse, reverse, there are some negative headwinds for copper here going forward. So I would be very, very cautious.
Very interesting. Do you have the same kind of concerns about nickel moving forward?
All metals, the other part of the issue you have is how the world is sort of segmenting itself away from each other. And I think the reason for the buying of a lot of these metals is also, what if we wake up one day and, China says we're not going to export nickel, we're not going to export copper, we're not going to, all these products that we tend to export, or Indonesia for that matter says we're not going to export nickel, which they have threatened at a number of instances to do. And so that's why you see the high volatility in the marketplace, because there's just an awful lot of uncertainty. And I would think for a lot of the base metals complex, you're going to see a very, very volatile market. I would be a little more concerned on the downside than the upside at this point in time after such a good run. But expect this high volatility these days of 5, 6, 8% moves. I think that's going to be the norm in 2026.
I wonder, you're talking about supply and demand, and we've seen an increase when it comes to China buying up a lot of critical metals, sorry. How do you think that might affect things moving forward if we see that demand coming from China?
Well, I think for the mining companies themselves, that's great. China has been a huge buyer of mines globally. They've been going on a shopping spree, particularly in Africa and in some Asian countries. And I think now that you're starting to see the West say, wait a minute, we can't have China have monopolistic control over all these metals that we need, particularly when the US seems like they're threatening war with this country and that country, and the defense complex needs a lot of metals. That could lead to a lot of consolidation of the miners. I fully expect to see a lot more M&A in this industry. And I think that's really good, particularly for the junior and small miners. I think their day is coming where people are really starting to say these assets are going to be a lot more valuable going forward because of the geopolitics.
Does it seem counterintuitive, though? I mean, a lot of investors are watching for potential tariffs being slapped on some of these metals by the U.S. this summer. Is that counterintuitive for the U.S. to be doing that?
Well, everything the U.S. seems to be doing seems a little bit counterintuitive at times. But it is what it is. And I do think, though, I'm more concerned about China cutting off the world and, countries in Europe who desperately need metals, in North America, et cetera. All these countries are starting to say, wait a minute, we need a long-term plan. Now, remember, from buying a mine or an asset that's in pretty early stages to actually development takes a really long time. So you need a long time set. But again, if you look at these companies and where they're trading, particularly where the price is, they're incredibly undervalued. And I think at the end of the day, some companies are going to figure this out. You have seen some M&A activity in late 2025, but expect for a lot more M&A activity going forward.
Okay, so much to watch for. Kenneth Hoffman, head of commodity strategy for Red Cloud Securities. Appreciate your time. Thanks so much.
Thanks for having me.
Recent developments in Venezuela are raising questions about the global oil industry and how they might impact Canadian crude. We've got more on that right after the break. Stay with us. After U.S. President Donald Trump vowed to rebuild Venezuela's energy sector, many are calling for Canada to ramp up its energy exports. Earlier, we sat down with Grace Wilton, senior energy advisor at Enpro, to discuss how all this might pose as competition for Canada.
I think it'll be clearer in 2026 as the Memorandum of Understanding stipulates certain milestones have to be achieved, specifically a project proposal and approval by the federal government. Right now, there are many sides saying that there is opposition there, like your commentator just said, from your EB. But in the short term, we don't have competition. In the long term, there's definitely something to worry about, as the Venezuelan oil is the same type of crude as Canadian is providing currently to the United States. So, yeah, there's a threat there for sure.
Could this be the impetus for, we're working, everybody says the pipeline's coming, the pipeline is coming. Could this be the final nail, though, I guess if you want to call it that gets it going, or the final push that gets it going?
I think this is where the rubber meets the road for sure. If you can't get a more clear signal than oil companies being poised to invest or having the track cleared for them to invest in Venezuela as security increases and their safety concerns are availed, right? It'll be in the next few years that they decide whether they want to invest in Venezuela, which I'm sure they do. Obviously, President Trump has given them the green light and all the encouragement that they need. All they need is that stability. So this should be very much motivation for the federal government, for Carney to use Bill C-5 and approve what he needs to approve as these proposals come before him. I think he has given the signal that is going to happen. I believe that that's what we will see. Yeah.
And if we do see the pipeline actually starting to come to fruition, would that be appealing to some of those companies, the oil companies, if they would look and go, look, everything's already in place in Canada. We have the know-how, we have the stability. Would that be more appealing than try to restart Venezuela?
Sure, for sure. I mean, if they have a green light from Canada, knowing that a project is pre-approved, then you've got security and stability that is underpinning those investment dollars from those companies. I'm sure that the United States will make it attractive for companies to go into Venezuela, because ultimately they want stability in that region too, right? But I don't think anybody wants anything less than stability for Venezuela, for their, for all the people that have fled that country to be able to go back and prosper. So I definitely think that as well as securing the stability of this hemisphere is a priority for the President of the United States. And I mean, he talks about bringing 50 million barrels of Venezuelan oil into the states. That's basically I believe what's happening right now. So that's the equivalent of about 150,000 barrels per day. And that is poised to ramp up and could be displaced by Canadian crude. However, I think that there's a fine balance, and I think that Carney is definitely motivated to approve what's necessary to bring Alberta oil to Tidewater.
And now there has been concern that there isn't a demand for it. Is this a case that if we build it, they will come?
I think that there is a demand for it. I mean, the type of heavy crude that we export is used primarily in construction industry. There are a lot of like asphalt and adhesives, what have you. There's definitely a lot of demand in Asia for that with the Belt and Road initiative. Lots of activity there in order to use Canadian safe, secure crude and bitumen to be further refined and used downstream there.
And just one last question. OPEC is part of this, is part of all this. What kind of they've already said that they're going to pause oil output hikes. There's a bit of a glut on the market already as is. What kind of factors could those be on everybody's decisions on what they do with Venezuela or what they do in Canada?
Oh, I don't know. That might be a question for our chief petroleum analyst, Roger McKnight. But I think at this point in time, the Venezuelan situation is separate from the OPEC situation. This is very much a situation that was spawned by the need for safety and security in the region, for nefarious activities to be thwarted and stopped, and course reversal on those fronts. So I believe very much that the Venezuelan oil question is not something that the OPEC cartel is looking at right now. What I was reading on the weekend was they met on the Sunday, and they very much wanted to make decisions independent of Venezuela. So that's what I've heard.
Okay, that's all the time we have. Thanks for watching Commodities. You can always email your story ideas to commodities@bnnbloomberg.ca.